We're talking about the consumer sector and funds that focus on consumption as a theme. In fact, we have a new such fund in the market right now. I'm going to bring in Dhirendra Kumar so he can review this NFO and find out whether or not we should be investing in it. Now, this is the latest offering, Dhirendra, from Reliance Mutual Fund, a mid and small cap R shares consumption. It will track the CNX consumption index. Tell us again how this fund will function and what sort of merit you see in it right now.
Yes, it is an index fund, and all ETFs are devised or are mounted on, all ETFs replicate an index, and whether that index is a publicly whether that index is in a public domain or a custom index, but this is actually this CNX consumption index is in the public domain. This is a little more diverse index than FMCG or a consumer index that we have seen in the past. So this fund is going to be very different from an FMCG index. Consumer goods account for about 43%, and automobile, telecom and energy also have significant allocation here. Besides that, we have media and entertainment, pharma, healthcare and services as part of this index. Top 10 stocks account for nearly 69%. So this is a public domain, and this is an index which will this ETF will track this index. And if we look at the past performance, it has been outstanding relative to the market. And last 5 years, this fund is up about 19%, nearly 20%, ending February 28th. So that is quite an impressive performance. But mind you, this is a kind of theme which will not do well when we see a broad-based market rally. What we have seen is a very polarized market in the last 5 years, and this is a set of stock, or the dominant part of this portfolio has done exceedingly well. If you look at the FMCG funds, they are up nearly twice, they have delivered twice as much return as this consumption index over the last 5 years. So we are just looking at one side of it. Yes, it is an interesting fund. It provides investors an opportunity to buy this select theme in a cost-effective way, but it is a very and it is mounted on an index which is available in the public domain, but it is not completely diversified.
Well, looking at other funds within the same category, Dhirendra, Mirae Asset India has the India-China Consumption Fund, which was launched in 2011. The performance has not been very impressive. Do you see any merit in this fund in particular?
Yes, there are other funds which are of similar kind. Of course, Mirae Asset India-China Consumption Fund is one such fund, but we have Birla Gen Next or UTI, the Lifestyle Fund. They are similar options, and they have also done reasonably okay, because most of these funds, if you look at it from a portfolio perspective, they keep away from the cyclicals or the commodity companies, and that makes it quite unique. But that apart, this is the segment of the market which has done well, and the cyclicals and commodity companies have struggled. So these funds have done well, but I don't think this should be the guiding principle. I think most investors are better off by diversifying their equity money well, and it is not that once your money is diversified or in a diversified basket, then they will be deprived of these opportunities.
All right, then finally, put it in a nutshell for us. For any viewer who's watching right now, does a consumer fund make sense, particularly the R shares consumer fund, the first one we talked about? Does it make sense to invest in that fund right now, given the market cycle that we're in?
No, at the cost of sounding like a stuck record, I would say that most investors are well off by keeping away from anything which is sectoral or thematic, and this is one such offering. So I would say that even this fund might have the potential, but this should not be your first option. This should not be the way investors should get started, or this fund should not be a dominant part of your investment.
All right, let's take a few questions that have come in from viewers. Archana Rai has written in. She's 30 years old, Dhirendra. She wants to create a corpus of 5 crore rupees over the next 10 years. She wants to know how much money is she going to have to put aside every month, and what is the best option right now in the market for someone with her time horizon and aggressive goals.
5 crore in 10 years So you need to save a lot of money. But that part, and it is entirely a matter of, how much you are able to save as much as possible. And I don't know whether you approach that 5 crore or not, because but my sense is that 10 years is good enough time period. And track our aggressive growth portfolio. It is made up of 5 funds, 10% allocation to fixed income, 90% to equity. We suggest annual rebalancing, and this portfolio will take you closer. But it is entirely a matter of, and the kind of return which you should expect is, maybe a 30-40% premium to fixed income or yield and prevailing fixed income. So it's very difficult to guess that how much, what exactly will translate into how much money saved will translate into an accumulation of 5 crore over the last 10 years. But save as much as you can and replicate this portfolio.
All right, let's take another question. Venkatesh has written in, he's planning to take a home loan from SBI. He's being forced, he tells us, by the bank to buy life and property insurance along with the home loan. He wants to know if the bank can actually force the consumers to buy these products, and if as a borrower he should be buying these products at all. Dhirendra?
The SBI might have given you the principal approval to your loan based on your credit worthiness, your ability to repay the principal and the interest for the loan which you are likely to take. But SBI can, but it could well be part of your agreement. It could be well part of the loan term of giving you the loan, that SBI wants you to have a life cover for you, and SBI would like the property insurance as well. So they are well within their rights to enforce this. But my sense is that most consumer should have the liberty, should have the freedom to choose a life insurance and a property insurance of their choice. So if you don't want to buy these policies, it could, they would like to ensure that they are covered, their risk is mitigated when you have these two insurance. So you can do the shopping around and inform SBI that you have these done, and so they are doing it in in mitigating their own credit risk, or the possibility of you not being there, and then who will repay the loan. So it is a good thing. It is important to actually take this insurance. This will also ensure that your house is guarded or protected against something happening to you. So in that sense, it could be a wise thing, and it could be a useful thing. But my sense is that SBI cannot enforce that you buy these two policies from them as well.